So much. I appreciate the opportunity to talk about inventory.
Awesome. Thank you for being here. I'm going to make a small introduction. After 6 years as an entrepreneur, 4 running an e-commerce company, and 3 as an inventory planner customer, Jill Liliedahl now works with merchants to be more efficient and make smart purchasing decisions. The presentation of Jill will have the topic Increase Profits and Avoid Missed Revenue by Forecasting Customer Demand. Jill, pleasure to have you here. You can do your thing.
All right. Thank you so much. I appreciate it. So I'm going to talk about how to forecast what customer demand is and help with increasing your profits and making sure that you're not missing out on revenue. So the basic idea here is we want to have enough stock on hand so that customers can spend money at your e-commerce store. When you're out of stock, they can't spend that money, so you're missing out on revenue. So I'm going to share my screen here and we'll dig right into it. So who am I to talk about this? I know we had a quick introduction, but I am a former merchant myself. So I came into an existing e-commerce business selling dog supplies. Bonus, here's my dog, Fenway. And we sold collars, leashes, treats, toys, all the good stuff. I'm a crazy dog lady. And coming into this existing business, it was really an interesting process because it was different than starting a business from scratch. So we had data, we had customer data, but operationally we had a lot of work to do and needed to really rework things. So we had no process for ordering inventory. Consequently, we were running out of things all the time. It was a surprise to us. We were also overstocked on things and just had way too many of some of our products. And so our process previously was basically to walk around in the warehouse and say, well, it looks like we're out of something here. I mean, we had no process whatsoever. It was a nightmare. I can tell you all kinds of horror stories. So from that, we started forecasting customer demand, started using Inventory Planner, which is the system I work for now, but I'm going to talk about forecasting in general and what it can do for your e-commerce company. So we were able to dig into the data, and I'll talk about some of our progress a little bit later, but just know that I have done it very badly, have gotten into the data, have taken up forecasting, and we were eventually able to sell our business instead of running out of money. So what is forecasting customer demand? The short story here is we are using past behavior. So those customer orders, what have they already spent their money on, in order to predict what will happen in the future. So the best predictor of what will happen in the future is where customers have spent their money in the past, not what they tell you they're going to do, but what they have actually done. And the idea is we want to have what our customers want, when they want it, and where they want it. So if you're selling on multiple sales channels, you have multiple warehouses, maybe you have a brick and mortar store and you're selling online, you need to have what customers want, where they want it, so that you're not missing out on revenue due to being out of stock. So let's talk a little bit about the big picture. So we're going to get into more kind of the formulas of how you calculate this and things to keep in mind. But I want you to think about your priorities as a company, as an e-commerce company. So first, is it cash flow? Is it, your top priority is making sure you're paying your bills, you're meeting payroll, you have enough profit in order to invest in marketing and grow your business? Is that your top priority? Are you thinking about growing? So if you're just starting your company, maybe you're working on building up that market share, acquiring customers, and looking at growing with less of an emphasis on cash flow, but please don't ever lose sight of that completely. Think about your risk tolerance. And by this, I mean related to inventory. Do you never want to be out of stock and you're the reliable brand? Or are you okay with some occasional stock outs? And maybe that sounds like crazy talk to say we're okay with some being out of stock occasionally, but there are some times where it can be okay. One, just in case you don't have all the cash in the world, you need to make choices about what you replenish and order from your vendors. Two, you can actually use some scarcity in order to drive future sales. So if you're not always in stock, or it ran out fast last time, and you're not just saying that as a marketing tactic, it's actually true, it can be used to your advantage. So think about kind of where you are on this spectrum of wanting to be the reliable brand that always has products on hand, or are you okay with some occasional stockouts? And we'll talk about some nuance where you prioritize some things you always do have in stock, and others you're okay with some stockouts. And then finally, I want you to think about another consideration. What is your brand value? And by that, I mean, are you about getting customers paying a low price, getting something as fast as they need? So a US brand that comes to mind is Bed Bath & Beyond. The coupons they have are infamous. You always need a coupon when you go in there. Otherwise, you're paying too much. It's just built in. Everybody has these coupons. You should be spending these at Bed Bath & Beyond. They're well known for that kind of discounting mindset. On the other side, if you're more of a luxury brand, a quality brand, your customers are less price sensitive, not saying that they're going to pay anything, but they're less price sensitive, then you want to be careful about discounting. And the reason that I'm talking about this when we're talking about ordering inventory is because if you're overstocked, people will a lot of times jump to discounting product in order to move it out. But if you really want to be careful about training your customers to expect discounts. There can be other ways to move out overstock, so that's not the only way that you can get things done by discounting them. But just think about your brand value when you're ordering. What happens if you overorder, you're overstocked? How do you move it out? So we can get into that. Just feel free to drop into the Q&A if you want to go into that more about how to get rid of overstock, and we can get into that a little bit too. So, okay, so that's big picture. I want you to think about where you are, what's your top priority as we head into thinking about how to replenish and make sure that we're maximizing our revenue, maximizing our profits, and have the stock that our customers want. So where are we right now? Where are you right now? What's the current status? So when I talk to merchants, and I've definitely felt this myself, the amount of data that you have access to can be overwhelming. It's a lot. You have Google Analytics, you have the back end of your website. Maybe you're using an inventory management system. That's another set of reporting. I mean, you can have all sorts of dashboards, right? And the number of metrics you can get access to. So I'm just going to point out a couple of metrics for you to keep in mind and look at to kind of get an assessment of what is our financial health, what is our inventory health as it relates to the financial health of our company. So at a foundational level, I think two good metrics to start with are stock turn and GMROI, which stands for gross margin return on investment. So get out your secret decoder ring. We've got some acronyms here. I'll try to spell all of this out. Okay, so let's break it down. What are these? So stock turn means how quickly are we starting out with our inventory and we're turning that back into revenue? How quickly are we turning over our inventory? So think about this as if I invest $1, €1, £1, whatever your currency is, if I invest $1 into inventory, how quickly am I turning that back into revenue of $1 or $2, whatever that return might be? How quickly are we doing that? If it takes us a week or two to do that, great. If it takes us several months, if it takes us a year to do that, that's a problem because guess what? I need to pay my vendor well before the customer's paying me. So I've got a cash flow problem. Okay. So we want to keep that stock turn healthy so that we are turning our investment into a return, and we're getting that revenue from the customer. So we want to keep that going. A typical number that I see, and there can be a lot of nuance depending on your business, your segment within e-commerce. A typical number that I might see is that you would turn your stock over every 2 to 3 months. And so, like I said, there are a lot of factors that go into that. You could have a hot selling item where you're placing a lot of little orders and it turns over monthly or even more. That's pretty fast. Or you're making quarterly buys, and then we would see that it would take a few months in order to turn that over. So that's stock turn. How quickly are we turning inventory back into cash? Then GMROI is looking at, okay, we invested $1 into inventory. Am I turning that into $1, $2, 5, 10, what's our return on investment? It's basically saying, okay, over and above the cost of our stock, what is our margin related to that? So what's our return on investment here? So both we're looking at speed of turning it back into cash, and then how large can we get that return on investment? So those are two good places to start if you're feeling that overwhelmed feeling, looking at data dashboards and everything you have access to there. Then, we're going back to those priorities that we talked about earlier. What are some good tools to get a sense of if those are aligning with our priorities, if we're making progress on some goals and becoming a financially more healthy company? So if you're really thinking about cash flow, take a look at both the cost value and the retail value of your inventory. What do I mean by this? So cost value means that's what you pay your supplier, your vendor. That's cost value. What is that for all the stock you have on hand? Then retail value is if you sold everything in your warehouse to your customers, what would they pay for it? That's the retail value. Okay. So these are two good measures. One, think about your stock cost in terms of if that inventory is sitting on shelves in your warehouse, you can't pay bills with that. You can't pay your employees with that. You can't pay for marketing with that. You need to turn it into cash, right? So the more that's tied up unnecessarily in your warehouse means that you can't use that money in a more productive way elsewhere in your business. Okay. So we want to strike that right balance so that we're maximizing revenue. Customers aren't met with stockouts, but also we don't want to have, I think of it as little piles of cash sitting on the warehouse shelves. We don't want that either. Retail value, and this is where we're getting into, you see this phrase on the screen, open to buy. This is a way of planning that says we have certain revenue goals. Do we have enough inventory on hand in order to meet those goals? The basic idea is, let's say in December, we have a goal of $1 million in revenue. I need to have $1 million worth of inventory at retail value in order for customers to buy in order to meet that goal. If I don't have enough stock for them to spend their money on, I'm never getting to my revenue goal. So that's where you can think about your stock retail value. You can use this tool called Open to Buy. I'm giving it just a minute here. It literally was an entire hour-long webinar that my colleagues and I presented earlier this week. So I'll put my email up at the end of the session. If you want a link to that to know more, let me know. I'm glad to fill you in on that as well. So cash flow, think about what is the value of your inventory, both cost and retail value. Risk tolerance. So this is, again, are we okay with some stockouts? Do we never want to have stockouts? Well, we can approach that question with some nuance. We can say our highest demand items, in this case, that's going to be A-class items. Those account for our first 80% of revenue, A-class items. Maybe those are the ones that we focus on first to replenish. We don't want to have any stockouts of those. That's your first priority, to make sure that those are in stock. So we're going to get into the forecasting a little bit. Maybe we see a long list of items that we should buy, but we don't have all the money to do everything that the forecasting says. So we start with those A-class items and say, these are the ones we're going to order first. Then B-class is our next 15%. These are items that we could be okay with some occasional stockouts. Not all the time, obviously, but occasionally they're lower priority when we're ordering. And then C-class are our final 5% of items. We can be okay with stockouts. And in fact, you may want to look at C-class items for actually eliminating from your catalog. So I think this can be a neglected thing when we're caught up in the busy day-to-day of running the business. Doing some product catalog cleanup and just kind of clearing out the stuff that's not productive. These C-class items, they could be a real money and time suck. You could be spending more time maintaining them in terms of ordering them, paying for shipment, paying to store them in your warehouse than they're actually producing for you. Okay, so think about, are they really delivering from you? Most likely not if they're in that C-class category. And so those could be the ones that you eliminate from your catalog. Okay. Then brand value. So this is, do our customers expect discounts? Is that something we do a lot? We've kind of trained them to do that. Or, are we out of stock often? How often are we out of stock? Do we have that scarcity model built in? So stock out percentage, meaning how often, how many days per month or per week we're out of stock, and then the number of discounts that customers are using. Those are some things that you can monitor if you want to have an eye on that brand value within your company. All right, so those are big picture things about how to think about how we're going to prioritize what we order, what we clear out, what our key indicators are for success as well. So let's get into how do we forecast accurately. So I talk to a lot of merchants who either have no system, just like I didn't have a system, or they're using spreadsheets, sometimes in a very simple way, sometimes in a very complex way, using spreadsheets with formulas. So let's get into some key concepts of using forecasting accurately. So there's two parts of this. We're going to think about how do we get the data to tell us what our rate of sales is. So we're thinking about, of our data so far, so of our customer orders, what is the appropriate reference period? We're going to get into forecasting methods in a little bit, but just briefly, if I'm thinking about seasonal items and I'm looking ahead to December, I don't really care what happened in July and August. I care what happened last December, and I care what happened the December before. Now, we could be looking at some year-over-year trends, so July and August may have a secondary effect, but primarily I want to know what happens this time of year. So I'm going to look back at the appropriate amount of time. Also, or alternatively, if I have a very trendy item, I don't care what happened last December. I want to know what happened in the last 14 or 30 days. I want to be super responsive to what customers are doing right now. If I have trendy items like fashion, this could apply, sometimes electronics, where you are just really needing to have in stock very quickly what customers want and to be responsive to that. Then the other part of that, the planning period, says, how do we apply that going forward? So that's where we'll think about, is this a seasonal item? Well, then we don't want to apply the same rate of sales forevermore into the next 12 months. We want to know, what is that trend line going to apply in the future? When do we have peaks and valleys? So we're going to get into some visuals of this. So we'll get into some more details here. So one of the key items as we're thinking about looking at that past sales data and looking at, okay, how many units are customers purchasing of each item in our store? One of the things we need to pay attention to is not just that we sold 30 units last month. So it looks like 1 unit per day as a rate of sales. We need to pay attention to when we were in stock and out of stock. What if last month I was out of stock half the time? That means we sold 30 units over 15 days rather than 31 days. Okay, so that just doubled our rate of sales. Really important to think about, when were you in stock, when were you out of stock? If you don't take this into consideration and you've been running out of stock, you're going to continue to under forecast what the true demand is from customers. You're going to run out again, and the cycle continues. So pay attention, when have you been in stock and out of stock? And that'll make a big difference to the accuracy of calculating your customer demand. Then so that's the past data. Now we're going to look at the planning period, which means going forward. How do we apply it? So here's where we think about the different forecasting methods. So what does this look like? So we could have a non-seasonal forecasting method, means things sell pretty consistently year round. There's not anything calendar related that would affect an increase in demand. We might see an organic increase in demand where maybe we see sales increasing over the last couple of months. Then we can put that emphasis on the last few months and say, okay, in this picture, we have fairly steady demand throughout this whole period. But if we see that increasing demand, then we actually want to have this going in a direction so that we're ramping up on stock. We're meeting that increased demand. So this is a non-seasonal forecasting method where we look back at the last 6 months, 12 months. You could look at a long period of time here and then put that kind of weight, that emphasis on the most recent months so we know what direction that's heading as well. If we are looking at really trendy items, then this is where we want to look at a very short period of time. So previously we were looking at 6 months, 12 months, longer. Here's where we want to look at 14 days, 30 days, a very short amount of time. Now, the big caveat here is if you are looking at a very short amount of time, and I would think of 14 days as a very short data set, to calculate your rate of sales. Each new day that you add to that calculation is going to affect your rate of sales calculation a lot, potentially. So you could see very volatile recommendations from day to day or month, week to week, however often you're calculating this. So just be prepared that the recommendations can jump around a lot because you're working on a very small data set. On the other hand, previously, if we were looking at a whole year, each day, of course, will affect the rate of sales, but by a very small amount, just because it's a contribution to a much larger pool of data. Okay, so be aware, be emotionally prepared for this to jump around a lot. Know that that's normal if you're looking at a very small set of data. Then if we have seasonal items, so there's a couple parts of this. One, we want to get the general trend line. So you can see in the fall and in the spring, we have spikes on this product. That means in the future, we're going to have spikes in the fall and in the spring. There could be calendar related things. Maybe it's, starting school and school year ends, or something related to the weather. So we want to echo that same pattern that we're seeing. So we're going to calculate the rate of sales for each month. So we're going to say October, it looks like this, November like this, then it drops down in December, whatever that is. We're going to look at it for each month so that we can apply it to the same month in the coming year. For seasonal, you can also think about year-over-year trends. And I think this is especially important this year, where we saw demand for a lot of merchants just go through the roof when COVID lockdowns hit. So we want to get that year-over-year factor in too, and know that just more people are shopping online. Things are different. And so we can start out with our baseline here where we know the general pattern, but then we apply an additional trend on top of that. Okay, so in the way that we're applying this information to the planning period, there's two components. One is your lead time, meaning how long it takes to get items from your vendor. So if I place an order today, do I get it in 2 weeks? That's my lead time. The other part of this is called days of stock. You can think about this as your ideal stock cover. If I get that order in and I'm planning, how long do I want it to last? 30 days? Am I making a seasonal buy, so I want it for 90 or 120 days? So the days of stock is the other component there to our planning. Now, I often get questions about safety stock, planning and safety stock. And I think if you're doing this manually, maybe through a spreadsheet, you might do something like, okay, I want to build in a buffer. And so I'll add 5 units to my forecast, whatever this is calculating to be. There can be some challenges with that, or some problems that you might run into where, say, the demand for that item really takes off, 5 units won't be relevant anymore. So think about, how do we do this in a dynamic way? We actually add it into our days of stock. So if all of our supply chains were working perfectly, which I know they're not right now, say everything went according to plan, we would have 30 days of stock that I'd be ordering for, but I need a buffer. So let's think about planning for 35 or 40 days of stock. It's going to be dynamic because it's tied to that rate of sales that we're calculating based on our reference period. Okay, so every time we're recalculating that, we're getting a new buffer built in, and then it will be proportional. It's not that 5 units, but when we see demand take off, it's going to be 10, 15 units. This is building in the buffer so that we always have an appropriate amount of time for things to go wrong and still have enough stock on hand. Okay, so that is a lot about ordering, making sure we don't run out of stock. But my public service message to you is, don't forget about overstock. It's less exciting. It's less sexy to think about than ordering, but don't neglect it. It is a lot of money sitting on your warehouse shelves, and it really can help with your stock turn. It really can help with your cash flow. That's a huge part of what I paid attention to as a merchant, because we were so overstocked and we just had to chip away at that. And eventually over time, I actually getting into the next slide, we were able to improve our stock turn by 8x. So that was a combination both of ordering in and making sure we had stock of what customers wanted. We weren't having so many stock outs, but then also a huge part of this was just getting that overstock trimmed down. So we went through our stock 8 times faster kind of at the end of this process than we did at the beginning. So that's a huge change for cash flow. Another merchant that I've worked with, they've paid attention to their days of stock period. So I was talking about increasing it if you wanted a buffer for if things go wrong with your supply chain, but also thinking about the cost value of your inventory. If, let's say you have $5 million worth of stock on hand, they actually decrease their days of stock. This means they're ordering smaller amounts more frequently, but they weren't tying up so much cash in inventory. They actually dropped the stock costs, their cost on hand, by $1.5 million within 6 weeks. That's a huge deal, meaning that they have $1.5 million now that's liquid that they can use elsewhere in their business on more productive inventory, on marketing, on payroll, other ways to grow the business that they did not have before because it was sitting on their warehouse shelves. So that just makes a massive difference. Forecasting accurately for what customers want, and having tighter control over your operations because you aren't guessing so much, but you have data to really guide that decision that's being made. So just quickly, I'm with Inventory Planner. This is a software system that helps with everything that I'm talking about. So if you're just starting out, if you're still kind of in the beginning phases of building your business, you can definitely do this with spreadsheets. But once you get to a certain point in your operations where you're growing, you're spending a lot of time on this, that could be around $500,000 or $1 million per year in revenue. You may want to look operationally at some systems to save you time and get more accurate at this. And that's where something like Inventory Planner can come in and help out. Glad to talk about inventory questions, any sort of replenishment. Please drop me an email. It's here on the screen. Glad to help you out. Also, check out our website. We've got lots of resources on the blog that you don't need to be an Inventory Planner user to access and hopefully find those useful. Like I said, clearing out overstock. I've got some videos and some blogs on that, among other topics. So check out our blog as well. So there we go. That's the quick look at forecasting customer demand to make sure that you're not running out of stock, you're not missing out on revenue, and hopefully maximizing those profits, especially over the holiday season.
Thank you, Jill. Thank you for that awesome presentation. It was so much info, but really well structured. So yeah, thank you.
Awesome. Thank you. My pleasure. My pleasure.
Let's see if we have any questions from the public. Until then, I do have one question. Did you see any particular difficulties in any of your clients by industry? Like, is any industry with COVID? I mean, did you feel like any industry was particularly hard hit in this period?
Yeah, it's interesting. We saw, I would say, the second half of March, maybe a bit into April, everybody just sort of clamped down, saw a lot of business drop off. And then pretty quickly within April, we saw almost all take off a tremendous amount. Now, not all. We did see some lingering effects, but I would say easily 85% saw an increase after that initial drop off. That was scary, I think, for everybody. And then just are seeing continued pretty good numbers. Once we got into maybe July or so, we saw that spike kind of calm down just a little bit, but overall still very strong selling. I, along with I think a lot of other people, anticipate that the holiday season this season is going to be huge for merchants. I think all sorts of people are used to shopping online now that maybe weren't before. And we're just seeing overall stronger online sales. So I think that this holiday season is going to be big. We did, yeah, to answer your question, we did see a few. I'm trying to think. I don't know that they were industry specific. I am in some groups where, maybe people before were focusing on brick and mortar stores and needed to very quickly move online. And that could be a really big challenge to build up, all of the advantages that all the other speakers have been talking about over the last couple of days, your SEO, your paid advertisement, and, on and on and on. So that's a really tricky move to do very quickly in order to kind of bounce back and sustain the business there. So I think that's probably the biggest challenge, is if they had a big focus on in-person sales before and needed to move online really quickly.
Mm-hmm. Okay, cool.
Yeah.
Thank you.
Right.
One other thing I would like to add. Actually, it's more of an observation. If Romania is any kind of benchmark for the world, we are already in Black Friday, and I can say from speaking to colleagues in e-commerce in Romania, the numbers this year are much bigger than ever anticipated. So I think that you are right to assume that this holiday season will be special, because there is so many new late adopters, technology adopters that are coming to the fray now. So
yeah, you're totally right. We're already in Black Friday, even though it's technically a couple weeks away, but definitely, things are happening. Just from a shopper's perspective, do your shopping now, because there's still lingering supply chain issues from March that lots of merchants have not recovered from. So I think we could run into some inventory problems.
Yeah,
I've been talking to merchants for months that just have really long lead times. Their factories never caught up. They already know that they just can't get the inventory on hand that they need for for December. So public service announcement, do your shopping now so that you can get what you need.
All right. Cool. Well, thanks a lot for the presentation and for the Q&A. And
all right. Thank you for the invitation. I appreciate it.
Awesome. Thank you.
Right.
And everybody, we will be right back with Phil Gorman of Ecom Events and Juliana. And this will be our last session of this summit. So keep tuned. See you later.